All right, so let's get started because we have now an extended disclaimer. But anyway, today we're going to talk about how to select investments, which I think should be good. So basically, we're going to go through the decision-making process of if you'd want to invest in direct equities or ETFs or funds, active or passive, and then we'll look at ETFs and funds. So covering a whole variety of things. But first, our housekeeping item. So our new and improved general advice warning. Thanks to our friends in New Zealand, views expressed in this presentation are of Morningstar and not any individual, which I think would be me. Any advice is general in nature, and attendees should seek the advice of a financial advisor if they require tailored advice to their situation. And the New Zealand disclosure statement is available on our website at morningstar.com.au. So if anybody is still listening to this webinar and is not immediately gone to read this New Zealand disclosure statement, we are going to talk about how to select investments, which is exciting. So as I said, we are going to talk about some of the different decisions that we need to make as investors when we're picking what to put in our portfolio. And to go back a little bit, we've done a couple previous webinars and a podcast on the portfolio construction process. And what that is making sure that you start with your goals and you define your required rate of return. You then select an asset allocation target that helps you achieve that rate of return that you need to meet your goals. And then we start thinking about investments. So once again, we want to put everything in the lens of you and what you're trying to accomplish, not just picking a certain investment type because you heard from your neighbor that ETFs are great, or you heard from Shani that funds are great because she likes them. So what we're going to do is we're going to follow a guide that Shani wrote around how to select investments. So first I'll show you where the guide is if you want the written version of this. So I'm on the website. I am going to go over to Learn to Invest. And it's this guide right here, the Morningstar Guide to Selecting Investments. So we're basically going to go through that process. And yeah, let's get started. So we've just added something new to our Discover Investments feature. We already have a question. I will get to that. Thank you, Chris. Eager. We've added a new section to our website that tries to help you guide. It tries to guide you through this process. So basically what I'm going to do is go through this process. And really what this is around is that as an investor, yeah, you're potentially trying to find a certain theme. You are trying to accomplish your goals. And, in many ways, potentially you could be agnostic to the instrument you're using. So we're just going to go through this process where we go through and look at different pieces. So I'll come back to the website at the end, but we're going to get into the PowerPoint. All right, here we go. How to select investments. If anyone has any questions during this, mark.lamonica1@morningstar.com. We'll ask any questions now, but you can also send them through to me. All right, people in the room are waving. It's confusing me. First, I was asked to add this ridiculous slide. So it's actually my birthday tomorrow, and I had a little bit of a party. And so that is Shani at my party, and that is a cake that my friend Nat made, shaped like a pineapple. So we'll quickly skip past this. And the other thing is I got a mug, which I told them I would show, where they put my face onto, I don't know what, and it says stonks. And if you don't know what stonks means, you're in good shape. We can leave that here. Zoom in on it. Well, geez, Will, you'd have to pay attention. All right, well, zoom in quickly. Now it's out of focus, Will. You have one job here. All right, so that's the weird little mug. All right, back to the regularly scheduled program. So when we were talking about building a portfolio, we talked about how the whole purpose of going through that process was that you could find an appropriate asset allocation to help you meet that goal. So what that means is there are likely a number of different buckets, which we have listed down on this side of the slide, a number of different buckets that you are trying to get exposure to as an investor. And for each one of these buckets, you may potentially use different instruments. So we'll walk through some of these different examples. But really what you have to decide as an investor is these three questions on the other side of the slide. Are you going to invest in individual securities? So are you going to go out there and buy an individual stock or bond, or you're going to go into these collective investment vehicles, so funds and ETFs. Are you going to employ an active and passive strategy, or are you going to focus on an exchange-traded product or non-exchange-traded product? So basically what we mean are ETFs or LICs versus funds. Now, for each one of these asset classes, you may make separate decisions. And that might be surprising to people because there are a lot of people that are very passionate about the different strategies that we have here. So you hear all these people that are very passionate passive investors, but that doesn't mean passive necessarily works for everything that you're trying to do. Same thing for ETFs and funds. I think people are very into ETFs just because they're marketed a lot and everyone thinks they're fun, that you can trade them all day. But there's a lot of reasons why you wouldn't want to invest in an ETF. So that's what we're going to try to answer today. And we'll go through all the different reasons that we should think about. All right, so let's start. We'll start with, should you invest in individual securities or should you invest in a collectively managed security? So let's start down this route. So if you are investing, and we'll take shares as an example, if you're investing in individual shares, there should be a reason that you're doing this. And the reason needs to be that you believe that you can pick shares, in this case, that better help you meet your goals, not necessarily beating the market, but help you meet your goals, than outsourcing that security selection to either a passive or an active manager. So we wanted to go through this kind of finance jargony term of investing edge and sort of walk through what that is and where different places that you get edge. So edge simply means your advantage. So as an investor, is there an advantage that you have over a professional investor or other investors out there in the market that allow you to actually pick securities and help you reach your goal? So there are 4 sources of edge, which we've listed here, and I'll briefly go through them, and I can talk about myself as well. So informational. So informational edge means that you have information that other people don't. So either unique information that nobody else has or information that most investors don't. Now, informational edge is very difficult to get. So if we went back in time, before the internet and before a lot of, frankly, securities laws changed, there was a lot of informational edge, otherwise known as insider trading, that you had information that other people didn't. There still can be cases where there's informational edge, but it's very, very difficult to have right now. Number one, because data is disseminated across the internet. News, data, everything else is accessible by almost everybody at the same time. The other thing is there's a lot of regulations around companies where they're not allowed to provide information to analysts, for instance, that they do not release to the public. So those are some more recent changes. And basically the whole reason that all this stuff has happened is just to level the playing field. Now, there are very specific places where maybe people have informational edge. Examples, you hear this stuff about like hedge funds used to hire satellites to take pictures of Walmart parking lots so they could estimate how much, how they were doing during a holiday shopping season, for example. But informational edge doesn't really exist anymore. Analytical edge. So analytical edge means that we all have the same information, but some of us do a better job of interpreting and analyzing it. So this is where a lot of professional investors will tell you that they can do very well. That, yeah, everything's publicly available, but because of their experience and because of their education and their just raw talent, that they're able to take this information and interpret it in a way that most people can't. And that gives them an advantage when they're picking securities. So you, of course, as an individual investor, self-directed investor, could certainly have an analytical edge. There's no reason why you couldn't. And that's what our analysts here at Morningstar try to do. So I think what they're talking about is obviously looking at fundamental investing, understanding the industry, the securities that are in it. So that's analytical edge. Structural edge is an interesting one. So I very much believe in structural edge. And I think that's one of the main advantages of being an individual investor. So what structural edge refers to is it simply refers to the fact that there are, as professionals, anyone with a job, there are structures and rules and behaviors and competing priorities that are going to impact the way that you do your job. So the very simple one for structural edge is that if you are a portfolio manager running a fund, you presumably want to keep your job. And what does that mean? It means most investors, ones that do not, professional investors that do not have long track records, are forced to do some things like not fall behind their peers. Because, and this is more of an individual investor problem, because money that's invested in funds and ETFs is pretty fickle and moves around and chases returns, all things that we know are bad as investors, but we also have to admit that it still happens. Falling behind your peer group or an index has significant impacts on a funds management company's ability to make money. Because, of course, they make money by having more assets under management. If there are a bunch of outflows that go out of the fund, it's not a great place to be. So what can this behavior induce? Well, a couple things. It means a lot of fund managers can also chase hot stocks. And it means that a lot of them could also basically become closet indexers. So none of these structural issues that are around keeping your job, compensation, all of that impact individual investors. The other big structural advantage you have as an individual investor is you don't have as much money as a fund manager that's managing some huge fund. So the more money you have, the harder it is to go into smaller parts of the market. So if you've got a bunch of money to manage, and obviously depending upon your mandate, you potentially are going to automatically have to invest in these giant stocks because literally you can move the market because you have so much money. So it makes it a lot harder for you to deploy capital into small mid caps or even smaller large caps. So that's another structural advantage that individual investors don't have. So I certainly believe that we all have structural advantages. And I also believe behavioral advantages can be an area that individual investors can also excel at. And I'll sort of talk through why that is as well. But what does behavioral refer to? So behavioral advantage is basically just this notion that individuals are hardwired not to do well with investing. This whole fight or flight scenario where we always, and we went through a lot of these in a previous webinar, where we've got all these biases that are impacting our ability to invest. And really a lot of them fall under kind of those two categories of greed and fear. So if you can figure out a way to not let those impact you, behavioral advantages can be a big advantage for you as an individual investor. And there are structural reasons why it's very difficult for professional investors, regardless of their temperament, to do this with funds. Because once again, if I run an actively managed fund and I know that the market's going down and it's a really dumb idea to sell, I still can't do anything about it because if everyone is selling out of my fund, I have to sell things in the fund to meet those withdrawals. So even people that hopefully through their education and experience understand that the way to actually do well in investing is to not follow the herd and resist the impulses of what everyone else is doing. Even those people sometimes are caught up in having to follow the crowd because there are structural impediments for them doing something different. So that's behavioral. And we did a recent 2 podcasts ago, we were talking about funds and what they were holding, and we were talking about Magellan. So Magellan's a very high-rated fund by Morningstar here in Australia. And in this market run-up, Hamish Douglas, who runs Magellan and the fund, their various funds, has basically pulled a lot of money out of the market and has it sitting in cash. Now, he's able to do that because he has a very long track record. He is very well regarded, and frankly, he owns most of the company. So he's able to do that and follow his convictions, but that's a lot harder for a lot of other professional a lot of other professional investors. He thinks the market's overvalued, and he thinks the best thing long-term for returns is sitting in cash now to take advantage of those, of any potential market drops in the future. All right, so that's investing edge. So what does all of this mean? It means you should be self-aware enough to realize that if you choose to invest in individual securities, where your advantage may lie, and how that can actually translate in the decisions you make about what goes into your portfolio. Now, if I'll go back to this slide, if we list all of these different, asset classes, you very well as an individual investor could decide, all right, for the Aussie equity portion of my portfolio, or even my global equity portion of my portfolio, I believe I have an edge. In those cases, I'm going to pick some individual securities, but I don't know how to pick listed property. I don't know how to pick infrastructure. God knows I don't know how to pick fixed interest. So in those categories, I'm going to outsource that. So just remember that this does not have to be a one size fits all across every single asset allocation bucket you're looking for. Oh dear, now I went back to the pictures. Lots of people are raising their hands. I don't know what to do when people raise their hands, but if you want to ask a question, you should just ask it. This is like a shout out approach, not being polite. All right, so let's talk a little bit more about picking individual shares, and we'll move on to the other ones. And now people are just raising their hand to raise their hand. The next person that does it, I should call out their name, like some sort of surly teacher. All right, so we're going to talk about how you pick a share. So if you've decided, okay, we want to invest in share, you want to invest in shares, let's talk about what we think at Morningstar equals a great share. So we're going to start that man in the corner. That's Warren Buffett, a young Warren Buffett, but that's Warren Buffett. Jeez, now we have two more people raising their hands. Johnny, make a list of people that raise their hands. I don't know. We'll figure that out. We'll write it on the board. All right. So we're going to talk about picking individual shares. So at Morningstar, and this is not a unique thing to us, we believe that there are two things that go into a great investment. So the first thing is picking a great company. And we're going to talk about what a great company is. So our friend Warren Buffett there, he has this quote, and he has this concept around a moat. Now, what is a moat? So a moat, basically, if we go back to medieval times, what did a moat do? It protected a castle. So a moat for a company protects the company and is a sustainable competitive advantage, right? So it's protecting that company from falls in margin and market share. And just the whole notion, we talked about this the other day, that there's obviously a lot of competition in capitalism. That competition generally leads to good outcomes for us as consumers, either lower prices or better quality products. None of that's all that great for companies at the end of the day, right? So a company that can protect its margin, so how much it makes off of its revenue, so for everything it sells, how much flows to the bottom line, and companies that can protect their market share are what we consider great companies. So we'll move on from this very long quote, and we'll talk a little bit about where moat comes from, where this competitive advantage comes from. So at Morningstar, we rate all of our companies with a moat. So we have 3 moat ratings: wide, narrow, or no moat. Most companies go in no moat. Narrow companies are ones that we believe that have 10 years of a sustainable competitive advantage. Wide moat equals 20. So we believe there are 5 sources of moats. And believe it or not, these are the 5 sources of notes. So moats, not notes, moats. So I'm going to go through this quickly. If you have questions, ask them. But I know we've done this a couple times before, so I'll go fast. So intangible assets. So intangible assets, brands or patents. So when we think about intangible assets, when we have a balance sheet, there are tangible assets. A building, we own that building. It's on the balance sheet. Then there's all these intangible assets. So a brand is a perfect example that we have as a wide moat example. Coca-Cola. Coca-Cola's got a brand. They've been around for 120 years. People know their product. No matter where I am in the world, I can walk into a store and buy a Coke, and I know it's going to taste like, and that brand matters. Patent is another interesting one, patent and government licenses. So we could have a moat just because we've been granted legal protection. So patent, of course, happens a lot with pharmaceutical companies. They invent a new drug, and as a reward for all the research and development money they put in there, they get to exclusively sell it for some set amount of time. So that's patent. Cost advantage. So pretty simple. If I can sell goods and services at a lower cost than all my competitors, that's a huge advantage for me. It means I can make decisions that I can price my goods at the same level as competitors and I make more money. I have more margin. Or in our example, Amazon right here, I can undercut my competitors, and then I grow market share. And that's been Amazon's strategy, right? So they have continually driven down the cost of goods. They pass those along to consumers, and they have taken over more and more market share. Now, Amazon for a while was criticized with this. Everyone was saying, when are you going to make money? And they just thought, well, we'll just control everything and then figure out when we're going to make money. But yeah, that's Amazon's strategy. Switching costs. So switching costs, I think generally people are confused about this till we explain it and they go, yeah, that is a pain. So switching costs refers to if it is difficult for you to switch from one product to another or one company to another. And the example we always use, of course, is banks, because it's a pain in the ass to switch your bank. So think about it. You set up your bank. You've got all your automatic bill pays in there with all your friends and all the other bills you pay. You have your direct deposit coming in. The other day, Shani and I got Laura, who's also in the room. We got her a birthday present, and I sent money to Shani to pay for it, which is very easy. I won't put what I put in the comments, but they found it amusing. But that's an example of switching costs. So people have all these multiple products with banks and multiple things set up, and they just don't want to switch. And so in order to induce somebody to switch banks, it needs to be a really good deal to go through that effort. Network effect. So network effect, we talked about this one, I think the other day. Everything's just blending together. Basically, it's when the value of a good or service increases as more people use it. So social media is the classic one. And I think I always say, yeah, it's no fun to be on Facebook if nobody else is. It's actually really no fun to be on Facebook. But anyway, the point is you want to share photos. You want to see what your friends are doing. You want to see their strange political rants and then unfriend them. But that's an example where Facebook, the fact that most people are on Facebook, makes it a more valuable good and service, and certainly makes it that way for advertisers, of course, because they can go on there and market to you. Efficient scale. So efficient scale basically refers to a company that's serving a very limited or niche market. And because they're doing that, other people just don't want to compete with them. So I use a railroad as an example, Union Pacific, a big railroad in the US. And basically no one at this point wants to build another track across the US. So what's the point in doing that? There's already one. There's not enough demand to go around to justify that. So we see that with we see it sometimes pharmaceutical companies, very narrow or very diseases that are not around a lot. So that's an example. So Union Pacific. All right. So we put everything in Morningstar within one of these 5 categories or multiple. You can have multiple sources of moat, but that is really a great company. Now, quickly, valuation. So I don't know if we're doing one next week. We periodically do one of these on how to value a share. But the other thing, in order to buy a company, you want to buy a great company and you want to buy it at a compelling price. So I just took this from the website. This is looking at InvoCare. And we're looking at what something is worth versus what it's trading for. So we believe, and obviously this is not unique to Morningstar, that there can be differences periodically in the valuation levels of the market in general and individual securities and what they're actually worth. And this is when all sorts of stuff, fear and greed, right now, I would argue greed, is driving valuations to a level that outstrips what the value of the market is. So our analysts calculate the fair value on every single company we cover, and then we simply compare it to the market and we get a star rating. So 5 stars, 4 stars, those are things that are undervalued. 1 star is things that are very overvalued. You can see we have the moat on there as well. All right, so this concludes the equity portion of our portfolio of our talk today, but let me show you one thing. I'll go back to the website. So for instance, when I go through here, if I select shares, I have different asset allocations buckets I can pick, but this automatically will show you where we think cheap stocks are. So those are 5-star stocks, or the biggest discount between what they're trading for and fair value. And then moats. So what are the companies that we believe have sustainable competitive advantages? So you see, we've got all these different asset classes. If I just wanted Aussie equity, of course, it takes everything away. But if we go back to all, then we see everything. So we've got global stocks, we've got listed property, et cetera, et cetera. So that's how you can actually figure out the asset allocation bucket that you are looking for. All right, so now we got to talk about, as I shift through my paper, now we got to talk about funds and ETFs. Okay, on Tuesday of next week, we will be doing how to value a share. It's exciting. It involves spreadsheets. Will gets really bored and upset and wishes we were talking about Bitcoin. It's very exciting. But let's go back to the PowerPoint slides. I've amused the peanut gallery. All right, so now we're going to talk about the next thing you have to do. So let's say you decide that you want to invest in collective investment vehicles. You sit there and you look through those sources sources of edge. You think about what it takes to evaluate a great company and one that's trading at a compelling valuation, and you think, that's not for me. I don't want to do that. Why don't I go out there and let a professional manage it? All right, well, now you have to decide, or it could be one of those cases where one of those asset allocation buckets, you say, I'm not spending my time on global listed property. I'd much rather spend my time doing almost anything else. So now what we're going to look for, we're going to look across active and passive. So we're going to see the strategy that we can use. Now, once again, people are very, very passionate about active versus passive. I will say that they work very differently in different markets. So let's think about these asset allocation buckets, and let's remember that we don't have to make a one-size-fits-all distinction between them. So let's start with efficiency of market. So basically what the efficiency of the market is, and we talked about the other day, the efficient market hypothesis, and basically the efficient market hypothesis states, when it came out in the 70s, it states that markets are perfectly efficient, meaning they are always perfectly priced. And they're priced by the data that's available, and that when new data comes out, the price will change. Now, I don't believe in that. It has been sort of thoroughly debunked, but we still have to understand that there are some markets that are more efficient than other markets. And when we talk about efficiency of the market, we're talking about how much do prices of underlying assets match their value. So in that same example, we are using stocks, where I was talking about the difference between what we think something's worth and then the value for what it's trading for. That's what we're talking about. Now, there are a couple markets that are more efficient. And what those markets are basically markets where more people, Vipin, you now raised your hand. You're the first one to be called out. Efficient markets are ones where more people, you've gone on Shani's list, where more people are paying attention to them at the end of the day. So if we think about U.S. large cap stocks, so these are the biggest stocks in the U.S., there are tons of analysts and funds and ETFs and individuals that are looking at these stocks all the time. So naturally, the more attention you get, the more analysts that are working on them, the more efficient the market's going to be. So that's an example of something that's very efficient. That's a case where maybe you want to go and use a passive investment vehicle. So if all these people are looking at it, if something becomes, and they can have different opinions, but sort of through the wisdom of crowds, if something becomes a little bit mispriced, then all of a sudden everyone will buy it. And there's just lots of people paying attention to what's happening. So in those markets, we want to potentially invest passively, or we would recommend that you invest passively. And the way that we measure this, of course, we have no idea, right? So we have no idea what is efficient and what isn't efficient. But the way that we measure this over time is going back, and at Morningstar, we have a report called the Active Passive Barometer. And literally we go back and we look at, okay, what are the percentage of active managers that have outperformed in different markets? So for something like U.S. large cap equities, big U.S. companies, big stocks, in that case, active management has done really poorly. And the theory, of course, behind this is more people are concentrated on it, it's more efficient. Less efficient markets where active managers tend to do a lot better. Fixed interest is one. So I think and we come out with this active passive barometer every 6 months. believe the stat was 40 to 60% of active managers in fixed interest outperform the market. Why? Because there's less attention on all these like esoteric parts of the fixed interest market. Same thing with emerging markets, small cap stocks, all places where active management may work better as long as you can find a good active manager. The next thing, of course, is fee hurdle. So fees have been coming down a lot, but fees are still higher for active management. You have to pay for that active management. A bunch of people sitting in a room trying to figure out what to buy. You're paying their salaries, and they're not cheap. So there is a fee hurdle. So you have to determine, obviously, with everything else, is that extra fee worth it? In many cases, it's not. How representative is the index? So this is an interesting one. So basically what that means is within the universe of what a fund manager can buy, how representative is the index of that universe? Basically meaning if it's completely representative, then the fund manager and this index or the universe are the exact same things. Cases like fixed interest where there are so many different types of bonds and so many off-the-run bonds, so all these bonds that are trading on the secondary market, that the index does not reflect all of this choice that's available for a fund manager. That's a case where a smart and good fund manager can outperform. So if the index is really representative, like the S&P 500, for example, and if that's the mandate that someone's following, then passive is probably the way to go. If it's not representative at all, and there's all these different corners of the market that a smart manager can go into, then potentially active works better. How liquid are the assets? So liquidity in assets simply means how easy is it to go out there and build a position? Like how much are you going to move the market if you're trying to build a position in these securities? And the reason this is bad if a market is illiquid, if it is difficult to access, so same thing, small caps, fixed interest, it's very difficult to be a passive manager because you are not making any decisions around timing. You're not making any decisions about how long it takes for you to allocate money to a certain position. The index change is something you need to go out there and make sure that your portfolio is representative of that index. So if you're dealing with small cap stocks, it can be hard for you and all of the other passive managers that at the exact same time need to move money into this new position that went into this index. It's very hard for you to efficiently buy those assets without moving the market. So by moving the market, it means the price is running up on you as everyone's buying this. Whereas if I'm an active manager, I can very slowly build a position without worrying about moving the market. So that's something where if you're a passive investor, you want a very efficient market. Once again, liquid market. And efficiency and liquid generally go together. So like large cap US stocks, large cap Aussie stocks, a lot of efficiency because a lot of people are looking at it, and very liquid. So potentially an opportunity for passive management. All right. So let's keep going through, and I'll go back to the website. We're doing a lot of switching today, which is exciting. So if I go back and I pick collective investment vehicles, then I can select active or passive. And see, basically, we're on ETFs all, but if I select passive, then we've got all of our medalist rated, so our highest rated funds and ETFs by our analysts. If I go on active, the whole thing switches and we look at active. So in some cases, yeah, there's no actively managed Aussie listed property that we would recommend, but there are some passive. So, all right, I'll get to the questions in 1 second. We're at the last bit. All right, so the last thing you have to decide is whether to invest in a fund or ETF. So this is once again an example where I think people decide that they should invest in a certain instrument based on marketing or what their mates are saying. And in this case, everyone likes ETFs, which I know is personally devastating for Shani as she loves funds. But I think funds get a pretty bad rap in many cases, and let's go through why. All right, so what are the big differences, and how could your personal situation lend itself to picking one of these different securities? So transaction costs. Funds generally have no transaction cost. So a fund You're investing at the NAV. So generally, you don't have a transaction cost. ETFs, of course, you pay brokerage. So what does this mean? Well, it means that if you are investing a small amount of money every month, that potentially a fund works a lot better for you because you're not having these continual transaction costs of investing a little bit in an ETF. Now, there are ways to get around that through like micro investing and stuff like that. But that's something to think about if we're looking at funds and ETFs. So with many funds, they do have, and we'll get to that, a higher minimum investment, but you can set up savings plans. And Shani talks about her savings plan like every day, where you can drip feed your money in as you get paid. Management fee. You generally pay more for a fund than an ETF. And that's because there's a lot more infrastructure involved around basically this whole process of you investing in a fund. So there's fund accounting, there's certainly people that are transfer agents that are processing these transactions. There's just a lot more infrastructure. Now, these generally are not big differences, but you'll typically pay a little bit more for a fund. So valuation method. So when you go into a fund, you are always transacting at the net asset value. And when we say ETFs over here, LICs also are included in many of these. So net transaction value basically means that because of the way that you invest in a fund, you wait till the end of the day, they value everything in the fund, then a price gets set. All investors during that day go in on that price, buys and sells. ETFs can deviate from the NAV. Now, there's mechanisms in place to keep them around that NAV. What it does mean is just like when you're buying a share, or not just like when you're buying a share. What it does mean is there can be another added cost in there. So you can pay a bid-ask spread, you can pay brokerage, and you can potentially buy an ETF that's deviated from its NAV. This is particularly something that could occur during a lot of market volatility. So potentially you could be paying more than the assets you're actually getting in that ETF. Trading flexibility. ETFs are a lot easier to trade. They're a lot easier to trade because, number one, most investors have a brokerage account. You can just buy them in your brokerage account. The other thing is obviously you can transact in an ETF all day, where funds you can only transact once a day at the end of the day. Now, be careful about this because sometimes just because you can do something doesn't mean you should. So ETFs can lead to overtrading. But funds, particularly in Australia, are a giant pain to invest in. You're filling out all this paperwork. It all seems a little ridiculous and archaic, but funds are sometimes difficult to invest in. Minimum investment in ETF, once again, an ETF, you can buy one share of an ETF. You shouldn't because you're paying transaction costs and all these other costs. But yeah, you can go buy one share. Funds, they generally have a minimum investment that can be quite high. So that's something to think about in terms of when we look back at personal circumstances. Yeah, how much money do you actually have to invest? Then we added this behavioral risk. So we said ETFs have higher behavioral risk. What that means is that there's a higher risk that you're going to do something dumb. And the reason is because, of course, all these great things about ETFs, they're flexible, they're in their brokerage account, they're tiny minimums. All of those reasons would lend themselves to, from a behavioral standpoint, investing in funds. It's harder to get your money. There's just some advantages to that. All right. So we rate funds and ETFs, as I said before, same way, a forward-looking basis using our medalist rating, gold, silver, bronze, we think are good. Good means we believe they will outperform their index over a full market cycle, so at least 3 years. Neutral, we're not wild about them. And then negative, we think you should actively avoid them. So let's go quickly back to the website and then we'll get to some questions. So if you have questions, send them through. They can mostly be about my birthday, but you can ask other questions as well. So anyway, we've done the same thing, as I said. So we pick collective investment vehicles, passively managed ETFs. I can pick a certain asset allocation bucket. Obviously add as many as I want. And what you can see is our top rated funds and ETFs. Now, Shani's guide goes through all this stuff in detail. We also have this is a modal, I've been told. So with the tech team, when I talk to them, I talk about, let's create a modal. So this is a modal. So you can go through and read some of the stuff I was talking about. And of course, there is a link to the Morningstar guide to selecting investments. which I believe was the first guide that Shawnee wrote while she was on the team. So you wrote a couple before you were on the team, but I think that was the first guide you wrote. And anyway, we've got some questions, which is good. All right. So we've got a question from Chris. So this is a question that came in literally at 1:03. So 3 minutes after we started. Chris was excited about this. So he says, Michael Burry says the U.S. stock market is a bubble. I noticed the price to fair value for the U.S. is 1.09. Do you think there will be another crash? Okay, so I'm not going to say crash because crash is, not a great thing to say. All right, I'll talk about a couple different things. Number one, when we say price to fair value, just to explain this term to everyone, what we're doing is we're dividing the price of what things are trading for versus the fair value, which is what we at Morningstar believe the market is valued at. So price to fair value of 1.09 means we believe the market, the US market in this case, is 9% overvalued. But let's be careful with what we're saying there. So we cover a lot of stocks in the US. We cover 1,600 stocks globally. I don't have the US number off the top of my head, but it's probably at least half of those. So we do cover a lot of different shares. That price to fair value is of companies that Morningstar covers, and it is equal weighted. So what that means is when we come up with that overall market price to fair value, we are taking equal weighted for every share we cover. Now, that's not how markets work. So most markets, the S&P 500, for example, is market capitalization weighted, meaning bigger companies make up more of the index than smaller companies. So market cap is the size of the company. So just be careful that when we say the market's 9% overvalued, we don't cover a lot of the speculative securities. We also equal weight everything. So just remember that. I think the market's overvalued. I mean, we've done sort of podcast after podcast after podcast. We as a company think that. I personally think that. I think that there's a lot of speculation out there around all sorts of things. But we talked about SPACs a couple episodes ago. There's a lot of option trading. There's a lot of investment in small micro cap stocks. There's just a lot of speculation. So yeah, I would worry that if that stuff starts doing badly, it's going to destabilize the market. And even invested in large companies that are generally good, it's going to, it could potentially lead to poor short-term outcomes. I'll also leave it at that. I think Jeremy Grantham, who I respect as an investor and who we talked about a little while ago, thinks he's in the Northern Hemisphere. So he's saying late spring, early summer, we are going to see a crash. We'll see what happens. So obviously for us, that's start thinking, May, June, July, somewhere around then. Now, it's interesting that he came out with a date. Nobody else is ever willing to come out with a date for any of this stuff, but we'll see. So yeah, I'm a little concerned about valuation levels now. Okay, so we've got a question from Nina. So hopefully I partially answered that. After an investment instrument is chosen, how to choose a specific investment within an instrument. So especially uncertain within ETFs or funds. Morningstar metrics, gold, silver, bronze helps, but metrics change. Many ETFs and funds are very similar, like multiple Magellan ETF funds. Also, are ETF fund prices as important as security price? Okay, so let's unpack a couple different things. So obviously, I work at Morningstar. We do rate things. That is the whole purpose, to help investors make those decisions because there are so many different funds and ETFs. Those ratings change. They don't change that much. So generally, we won't change the rating on our fund or an ETF. We'll change it once a year because we are looking at the management team and our confidence in them to outperform the market, not on performance, which is always backward looking, and not on obviously individual securities in the portfolio. We're looking at the process. We're evaluating them as professional investors. There are a lot of funds and ETFs that are similar. So when you say multiple Magellan ETFs and funds, so Magellan and many companies now, because ETFs have done so well, a lot of companies are releasing basically the exact same product in an ETF to appeal to ETF investors. So when you say some of these are the same, some of them are exactly the same. They're not even similar. They're exactly the same. They hold the exact, and Magellan's a perfect example. Their flagship global equity fund is also an ETF. It is the exact same fund in ETF. like the same securities are in there. They have different characteristics, different fee levels, et cetera, all those things we talked through to appeal to different investors. But yeah, that's something that's important. Also, your last point, also are ETF fund prices as important as security price? No, they're not. So a fund or ETF price is irrelevant. It's completely irrelevant. Frankly, just like a security, just like a stock price. But yeah, fund or ETF price, what you should do is a fund will always be traded. That price will always be the net asset value. ETFs, look and see if it's deviating from the NAV, because what's important is the value of what's actually in that fund or ETF. So Lisa says, do individual funds state whether they are active or passive? They do. So they will certainly state whether they're active or passive. I showed you sort of on our this new screener thing that we put together. You can pick actively or passive. If you go through in any sort of fund or ETF screener, you can also select, but they will say if they're active or passive. So we got a question from Dennis saying, what about listed funds? Aren't they easier? Okay, so let's talk about listed funds. Yes, they are. So there's a couple different ways that funds are listed. So M funds is an example. So M funds is an example of funds that trade on the ASX. So some funds are listed. It is a lot easier, obviously, to access them. So basically, you still have to pay brokerage. So they are basically, that's similar to how, when I was growing up, but that's similar to how they trade in the US. It's all through brokerage. So you can access pretty much any fund just through your broker. You don't have to do this thing. I was shocked when I moved here, and you have to fill out all this paperwork, and then you go to the post office with your 100 points of ID, and then 3 weeks later you're in a fund. I just couldn't believe it. Of course, in the US, you can't tap your credit card on things, so I don't know. You tell me what's better, but yeah, they are easier. So check out M funds. It's a good place to look. And the other thing, of course, and what they basically do is they remove that issue that you have sometimes with funds and ETFs in terms of, particularly with LICs, where there can be large differences. That's a closed-end fund. There can be large differences between the value of the net assets and what it's trading for. Okay, Nina has a specific question. When will Morningstar's March 2021 ETF portfolio update be published? It's a good question. I should know that. Let me check with the team after this. So Nina, maybe if you can send me an email, mark.lamonica1morningstar.com, I will let you know. Oh, geez. Someone asked how old I am. You're never supposed to ask a girl how old she is. I'm the same age, actually, as I was in everything else. It's not my birthday till tomorrow. So maybe tune in Thursday to see if I look like I've aged. Did you ask that? No. Yeah, you know how old I am anyway. All right, somebody said they have a Yankees top for my birthday. Where do I send it? I'll tell you where to send it. But there you go. All right, so we've got a question from Sally, which is a good one. Do you rate the Moat ETF? And she's also asking, stop, are you moving the screen, Shani? Do you identify ETFs for fair value? So let's talk about those two things. First, we'll start with that Moat ETF. So Morningstar has indexes. We have an index business. We sell that index to providers of ETFs, for example. So we have a moat index. So basically what the moat index is it is stocks that we believe have a moat. So we talked about moats. So our moat ranking, we sell it to ETF providers who then release an ETF. So we do not rate the moat ETFs because we think it's a conflict of interest. So you can go buy a Morningstar moat, who I think Van Eck does it in Australia, I believe. Okay, I'm getting a bunch of shrugs from the one person paying attention. But yeah, Van Eck ETF, I believe, but we don't rate it because we think it's a conflict of interest. And then Sally says, do you identify ETFs fair value? We don't. It is a really good question. So I think what you're asking is, do we look at the underlying securities in that ETF look at what our ratings are on them, and then calculate what the fair value is. We don't, although it'd be good if we did. I don't know the exact reason why we don't do it. I'm sure there's a reason. Probably because there's also no guarantee that we actually cover every single security that are in all these ETFs. But that is a strong question, Sarah. You can go in and look at the underlying. Here, I'll show you. How about that? You can go in and look at the underlying other parts of an ETF. So if I go passively managed ETF, we'll just pick one. Let's pick an Aussie one. So if I pick this, an S&P ASX 200 ETF, if you go into portfolio, you can see certain things in the ETF. And you can see some of our ratings on these. So basically, so you can see price to earnings, price to book. So you can see different metrics there. You can look at moats. So if you're looking in this, and we say fund, we mean ETF in this case, same difference. You can go in and look at, 28% of the stuff in here has a wide moat, 30% has a narrow moat, et cetera. So you can go in and look at different things like that. So one thing that, this does not add up to 100%. That's probably everybody is looking, but that just means there are things in there that don't have a moat rating because we don't cover them. So that's the issue around moats. All right. Okay, so we've got a good question from John. So John's saying the moat rating and valuation doesn't seem to take into account how well the company is run, e.g. efficient use of capital, quality of governance. This means that one could fall into a value trap, buying a value stock, but in reality, buying a not so good stock. How does Morningstar advise around this? Okay, really good question, John. So what John is talking about is, so a moat, of course, is like if we want to talk about Coca-Cola, and yes, management could destroy Coca-Cola's brand. But at the same time, for hundreds of years, this has been built up. They've got a brand. We can look at valuation levels. But then, of course, management, and if you are an investor, management is running your company. They are allocating your capital, meaning that they can go out there and sources of capital could be cash flows that come in. They sell some stuff. They get cash. They could issue debt, equity, all this other stuff. They decide what to do with this money. They could return it to you as a shareholder through a buyback or a dividend. They could go do something dumb and acquire some company at a ridiculous multiple. They could decide that they all deserve a nicer life and give each other raises and build nice offices and have great company events. So yes, we need to look at as investors how capital is allocated for a company. So let me show you what we do. We have a capital allocation rating. If you want a rating, we've got a rating. So let's look at InvoCare again. This is like me talking up my own book because I own InvoCare. Here we go, InvoCare. All right, so the rating I did not talk about is this capital allocation rating. So we rate every company on a capital allocation basis, and Angus, our analyst and new father, will write on it, and all our analysts do. So basically, we have standard, poor, and exemplary are three capital allocation ratings. And you can go through and read about why we think management is either a good steward of your capital or a poor steward. So look at that. Every once in a while, I can answer a question. All right, a really good question by Rodney. This does keep me up at night, among other things. So Rodney says, any chance Morningstar might one day include data on overseas ETFs so that things like X-ray, asset allocation comparisons, et cetera, will work properly? All right, so this is where I have to say that I was the one that made the decision not to include data from overseas ETFs. So what that means is an ETF that is trading, not investing overseas, but is trading on a US market, for example. And the reason, and I don't know if this was a good decision, but the reason I did that is because I didn't want to confuse people, which probably isn't a good enough reason. The problem is, of course, like if I go into search and I look for an S&P 500 ETF, all of a sudden, all these different ETFs will come out if I include the US universe as well. And it means you could get confused as an Australian investor that was just trading locally because you're seeing stuff that isn't available locally. Now, the same thing's available locally, right? So like if I am an ETF provider, I would create an ETF and then with the S&P 500, for example, if I've got a SPIDER, so State Street Global Advisors. That's a big one in the U.S. Well, they've done the same thing here, right? So it's the same underlying securities. The fees could be a little different, but I just didn't want people to get confused around the where they traded. But I think probably it's better to figure out a way that we can use those. So it's a good point, Rodney. We should do something about that. Okay. So, wow, we have lots of questions. Someone wrote, thank you. Oh, here we go. Because Amy wrote lots of different times, I am going to try to answer this. Okay, so why do some fund managers with similar products have different returns? So specifically, Amy's asking about the Beta Shares Australian Shares ETF and the Vanguard Australian Shares ETF, which is Laura's favorite ETF. I'd have to go back and look at that. Now, I don't know if the Beta Shares product is also following the ASX 200. Maybe Shani will look it up for me. But yes, no, they should not have different returns. Differences in returns would be, of course, price. The fees that you're paying. The other difference is if there's a deviation between NAV and what they're trading at. But we'll get back to you, Amy, on that. Okay. All right, Rodney's got a good he said you could hide the overseas ETFs from search, ratings, et cetera, include them in the underlying portfolio data in X-ray. That's a good point. Rodney, you should take my job over, please. All right, so let's see. What else do we have here? All right, so we've got, so Michael's saying the ARK actively managed theme-based ETFs are highly popular, yet not mentioned by Morningstar. So basically, the ARK actively managed ETFs are very popular. We actually just started coverage of them in the US. Now, you won't be able to find that on our website because it's that same thing where it's not actually in Australia. Now, you're talking about a way you can access it through the ASX. Yeah. Send me an email, Michael, and I'll send you our rating on ARK. And yeah, we recently started covering that. Okay, so I just heard from Shani that Vanguard Australian Shares, Amy, the Vanguard Australian Shares, that's tracking the ASX 300. The Beta Shares Australian is tracking the ASX 200. So they're tracking different indexes. So that would account for the different returns. There are, of course, 300 securities and 300, 200, and 200. But that would account for the differences. But I'll look those up. All right, we're running out of time. Okay, I'm sorry. We're running out of time. But, and Rodney said that too. See, Rodney is answering all the questions. He actually answered it, Shani, a minute before you. So maybe he shouldn't just take my job. He should take your job as well.
Please put me out of my misery.
She said, put me out of my misery. All right, Rodney. So send your resume to that mark.lamonica1 email address. All right, we're out of time, unfortunately, and there are a lot of other really good questions. So I'm looking at yours, Luca, and Wayne, and of course, the anonymous attendee. So please send those through to my email address. So it's mark.lamonica1@morningstar.com. And thank you, Nina, for saying happy birthday. There's my mug again. But I'll be back on Thursday, and we will talk about investment risk and how to think about investment risk. So thank you guys very much.
Any advice in this video is general advice or regulated financial advice under New Zealand law prepared by Morningstar Australasia Proprietary Limited and or Morningstar Research Limited. without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.